Now, many people know about the USDA Guaranteed Loan, but others do not know about the USDA Direct. This form right here, this PDF file that you can find on the USDA website, tells you the difference between the two programs. Now, even though this says Georgia, this still pertains to both loans and the differences that they both have. So the thing about USDA Direct is it's for low to very low income households. So depending on how many people you have in your household, there is a limit that you are able to make. And right here, it tells you. If you click on the link right here, it should take you directly to it. And so with the direct program, it has to be for both of them, you have to be in a rural area. Now, right here on the side, it says, what is an eligible area? It says generally rural areas with a population less than 35,000 are eligible. Now, they actually have a website where you can go and you can look up the address of a property that you may be interested in. Now, what a lot of people don't know is that there are also low income limits. So you can have low income and you can have very low income. But there is a limit. Now, I'll tell you everything you need to know about this program. So make sure that you subscribe so you can have more information about this, because I will be putting up more information. So basically, with a direct loan, the house size has to be modest. So what that means is the home usually has to be under 2,000 square feet. Okay. And also, there's no swimming pools. And so let's get into how much you can borrow. Now, for how much you can borrow, it's like an eligibility calculator that they have that you can check to see based on your debt that you may have, which may be student loans, which may be credit cards, an auto loan. You can check, you can add that information on the website that I will show you. Now, the thing about that is they do want you to have a credit score of 640. They do want you to have a credit score of 640. But if you do not have a credit score of 640, I will show you the information where it lets me know so that you guys can see it, where I found this information at. Regarding that, if you do not have a 640, as long as you have 2 trade lines, which shows that it was open for 24 months and it was paid on time for 12 months, for the last 12 months, out of those 24 months that account has been open and they were paid on time, you have your 2 trade lines. So if your score is under a 640, if you have 2 trade lines and pretty much don't have any collections, then you can still get approved under a 640. You're able to have. Okay, so see, it says applicants must meet income eligibility for a direct loan. Now, let's go to the Single Housing Direct Eligibility Assessment Tool. Now, this is for the 502 Direct Loan Program, which is the USDA Direct Loan. This is not for the Guaranteed Loan, the regular USDA Guaranteed. And as I said, with the USDA Direct, you don't have to have a 640. But if you have a 640, say for instance, you have collections. If you have collections on your account, but your score is a 640, then that you will typically still get approved because they won't have to do any further research because you have the score that is needed to get approved. Now, if you are under a 640 and you have collections, then they're going to have to research that and find out why you have those collections and why you haven't paid, because you still have to show that you were willing and able to basically pay the amount and not basically just leave it on your collection and just say, oh, okay, it's a $200 balance, I'm just not going to pay it. So they're not going to want to give you a loan if they see that you have a $200 balance on your credit that you could have paid or made arrangements to pay. So the thing with that is you should be trying to pay those off if your score is under 640. Now, as you can see on here, it has the single family housing guaranteed. Then it has a single family housing direct. Now for the guarantee, that would be a totally different video that I'll probably do later on. That basically shows you your eligibility limits and different things like that as well. Now, for this assessment tool, this is where you can find out what needs to be done. They also have the income limits right here that we will also discuss. And so what you can do is you can look up your state and your county. So for instance, let's look up the state of Alabama. Now, this is Bullock County, Alabama. And let's say you have 4 people that live in your house, including your children. That's 4 people. So the grant income will be about $16,100. For very low income, it will be the max. You are not able to make over $26,800 in the total, for the total adjusted income in the household. Now, everybody has different situations. They have medical deductions. They have people that live with them that are disabled. You get deductions for that as well. So it's many different things that, can still make your adjusted income at the limit that it's supposed to be. Now, for low income, you cannot make more than $42,900 for 4 people. Now, say, for instance, it was 5 people in the household. So for the low income for 5 people, it will be $56,650. So that means that you guys having more people in the household, you're able to make a little bit more. And so as long as it's under that 56,000, you are good. Now, the thing is, you don't have to be under that amount base typically, but that's how they categorize you as far as being low income, very low income, or grant income. Now, those incomes like the grant income, very low income, and low income are the income levels that will be able to get you the subsidy. And so you will be able to get, like, for instance, they'll give you a home loan maybe for about $100,000. in Alabama. So if you get that $100,000 loan, you do not have to pay any down payment. And also what happens with that is that you will get a subsidy. So like they are able to make your mortgage between 33 years payback or a 38. They have a max of a 38-year payback term. So if you are in those ranges where, you know, say for instance, you, like I said, for 4 people, you have the $42,900 and you guys make under that, you guys will be considered low income, and then you will be able to get the subsidy on your rent for 4 people living in that household for a $100,000 home loan. And so I hope you guys can understand, break it down so that you guys can understand what I'm saying, because it can get very difficult to understand this housing situation. Now, another thing, if if the mortgage was typically supposed to be with a 30-year mortgage, it would typically probably be for a $100,000 loan, maybe I'll say $800 a month, maybe $700, depending on what the interest rate was. So with this program, you'll be paying most likely about $400 a month. So you could be paying like $400 a month for your mortgage for a $100,000 mortgage. So these are just estimates, but this is basically just letting you know like what a typical mortgage will be for a 30-year mortgage. You guys will be able to get a 38-year term or a 33-year term payback and be able to have a 1% interest rate. Now, these are the different counties. So if you go to the different counties, you're able to make more money. Now, they have also the moderate income on here as well. Let's go back up here. So then they have the moderate income. So they have the 38-year term, like I was saying before. So if you have 4 people and you guys make under $32,150 for that year, you guys will be able to get that 38-year term. Now, for the moderate income, those are typically for people to get the USDA Guaranteed loan. So, because with USDA Guaranteed, you can have moderate income for that. So, we're going to be focusing on the USDA Direct because that's the program most people really typically don't know about. And so, these are all the counties in every state that they have for the program. And most of these counties are going to mostly have cities that are in rural towns. So that's why they have specific counties on here. So let's go back and let's look at the single family housing assessment. Now, we're going to put and that's the great thing about this program with the subsidy and all of that. You could either build a single family home, purchase a single family home, or refinance on an existing single family home that you have already. So let's do, and even like, for instance, if you wanted to purchase a new construction home. So say, for instance, you want to purchase a new construction home. It was just built. So we will purchase a single family home. Hit accept. Now, you're going to pick a state. Now, let's just pick like Louisiana, for instance. Now, we're going to put a county here. Let's just put a county. Now, they have certain counties that are able to get certain limits. Now, for instance, they already have the one applicant in there that will be putting their information. It will automatically be right there. So if you have someone else in the household that wants to be a co-applicant, then you can add them as well. But say, for instance, you may have a spouse and that spouse doesn't work. You don't have to put them down as a co-applicant. You can put them down as an adult household member. Now, there are different specifications when it comes to having a spouse in the household, because depending on if you're in a community property state, they will need the information of your spouse's credit information, like what's on the credit information, and then they go from there and they will include that spouse's income into the debt to income ratio. Now let's just put 2 dependents. So we have a total of 4 people in the household. Now it's also asking if the loan applicant or the co-applicant is at least 62, or are they disabled? Let's put no. And then, are there any disabled people living in the home? Let's put no. Now, they usually want you to put in an estimated annual property tax. So say, for instance, you see a home and you already know what the taxes are for that home. So we'll put about $1,500 for the annual property taxes. And then we'll put about $500 for the annual insurance. And this is, yearly. And then homeowners association, we'll put maybe $300 as well for that year. Because they're going to break that down within 12 months and they're going to add it into the income that needs to be deducted. Okay, so do you have any other funding sources? No. We're going to put no. Like grants or anything like that. Okay, so this is where they ask information of the other member. And then they ask the information of the applicant. And so we'll put the base pay as about, for the month, we'll put about $2,000. And for the other member, we can put zero. Just put zero for them. Now, if there's overtime, you can put overtime because they will calculate the overtime and make it to where they're able to get an average number of how much you make for that year. And they usually can go off your past 2 years of work history as well, because they want you to have stability within the last 2 years. It can be different jobs if it's in the same work category. So they do look for that. If it is unstable, they can still go through the process. They just will calculate everything differently. So, okay, let's just do that. Now, for the debt, you put the type of debt. Like, say, for instance, you have an auto payment. And the auto payment is about $300. So, as you can see, dues right here, they put it in there with the monthly debt. So you got about $300 right here for the auto loan. And then, like, if you have school loans, you could put that too. You would put add new, and then you would put in, you know, child support that you pay, that you have to pay, the installment loan, the credit card, the student loan, co-signed loan, other debt. You could put all of that information in there. But we're not going to do that right now. You can do that though, if you have that. And so it also asks you if you have any of this, you fill this out, you know, based off what your information is. Now, that's for people like at the bottom here. If you have any collections or anything like that, you will put basically yes, if you have outstanding collection accounts. Now, the thing about the collection accounts is they don't want you to have like a lot of collections and then you pay them off less than 6 months from the time that you are applying for the program. So, for instance, if you know you're going to get in the program and then you just start paying off all of these collections, that's going to be indicators of unacceptable credit. And so, like, it's this right here. It says, for more detailed description of indicators of unacceptable credit, click here. So you can click that information right here. They have different indicators that let them, you know, have to go through the process more to see if they can get you approved or not. Now, usually if you have like a collection or anything like that, you need to explain why you have that collection. You usually need to do a letter and write a letter explaining why you have that collection. But this is a complete list right here of indicators of unacceptable credit. Now, this doesn't necessarily mean that you are not going to get approved, but they're going to have to research this more into detail. And they're going to have a good explanation on why you have it. Now, it does say right here, an applicant with an outstanding judgment obtained by the United States in a federal court other than the United States tax court is not eligible for a Section 502 loan. This requirement is statutory and cannot be waived. So there is some where you may not be able to get approved based off what your situation may be. Now, I'll go to something that is most people may have, which is the outstanding collection accounts with the record of irregular payments with no satisfactory arrangements for repayment, or collection accounts that were paid in full within the last 6 months, unless the applicant had been making regular payments previously. So, say for instance, you had an account open and you have been making payments on that account, like regularly, like on-time payments for like 6 months. And so you decide, okay, let me just go ahead and pay it. Or for basically however long you had the account open and you have been making regular payments for that account for as long as it's been open, you can pay it off less than 6 months because you have been making those payments. Now, if it's a small collection, you may have like one collection on there and it's like maybe $200, then they probably won't make it a big issue of you paying it less than 6 months. But you would still most likely have to write an explanation letter letting them know what's going on. But what you can do is also just wait till it comes off of your credit and then apply. So, it's kind of best I can tell you different tips on what to do to actually get approved and what you can do to actually wait, do what you need to do, and then wait and then apply. But we'll get into that on another video. So let's get back to this. So let's put no for everything. Let's just say typically, let's just say you have none of these. You don't have a collection. You don't have any debt. But like I said, if you do have collections on your account, but your score is a 640 or above, you will most likely still get approved, and you will not have to pay those collections to get approved for that loan. Depending on what the collections are and how much they are, you will not have to pay that back if you have a 640, because you have the score that is needed. Now, let's look at this right here. So for the state of Louisiana, the county East Baton Rouge Parish, you will have basically an annual household income of $24,000. Your deductions is your children. So the deductions are the children. So they take a certain amount for each child, and they total that up. And so that came up to $960. The household adjusted annual income was $23,040. So the maximum adjusted annual income for selected county is $62,800. So what that means is, for that county, your annual income, the maximum that you were able to make for that county is $62,800. So if you make over that, they would have said that you do not appear to be a good fit. But because your income annually is under that, it says that you appear to be a good fit. And so what happens is, your adjusted monthly income from what they calculated for what you put in is $1,920 a month. And so your monthly debt obligations was $325, because you have the auto loan, and then they included the other fees from the homeowners association fees. Then your monthly insurance, from what we put in the beginning for how much the home was, the house taxes was. So that was an estimate. They said that monthly insurance / taxes will be $166.67, which gives you an estimated maximum loan amount of $110,700. So you see that loan amount right there? That's a good loan amount for someone who has a low or very low income. Now, once you get this information, you can use this as a reference to see how much home loan you may be able to get for the USDA Direct program. So after that, you have to fill out an application. You can find the application online, and you will send it to that address of that county for that rural development county. So depending on what county you live in, you will be able to fill out the information and send the application in to that rural development office, because each is different offices in different counties. So you will have to send it directly to that office. They also have it where you can fill it out online, but it is not user friendly to fill it out online. You will have to register your account, register for an account, and you will have to add Adobe Reader. You will have to have Adobe Reader. And like I said, it's not user friendly. So most people would just, actually fill out an application, a paper application. You can get it online, or you can email the rural development office in your county and request to get an application. They will also tell you what needs to be on the application and how you need to fill it out with the information that they will send you in the application packet.